As oil prices go up, so do oil companies' shares. Crude trading near a 31-month high this morning, and giants like ExxonMobil, Occidental, and Shell all reporting standout quarters. Here with more now is Phil Weiss. He's a senior analyst at Argus Research. He's also a Bloomberg Best. Phil, thank you for joining us on the phone.
Oh, thanks for having me.
Well, oil's been climbing steadily since late last year, and we know that energy companies are slated to report some of the fastest profit growth within the S&P 500. So give us a sense of just how strong these first quarter results are compared to already lofty expectations.
So far, companies have generally been exceeding expectations, and they're posting their best results since 2008.
So can this last then? I mean, how much longer will this go on before we start to see some of these companies come under political pressure?
Well, I think a lot of it's going to depend on what happens with the economy. As we saw in 2008, eventually oil prices got to a level that was too high. And once that happened, demand for gasoline started to fall, and then oil prices followed with them.
Now, who among these oil companies, let's just separate the winners from the losers here, is best or perhaps least able to capitalize on rising demand for energy? They're able to boost production when it counts and bring in more money.
One of the companies I think that benefits well in this situation is Occidental, and there's a couple reasons for that. One is because of the fact that Occidental is highly tied to oil prices. Oil is a bigger piece of the production. A second is that they have a really smart management team that seems to be able to do a good job of increasing the amount of cash flow they allocate to production and development activities as their cash flow increases. And we noted that yesterday when they announced earnings and also increased their CapEx budget for the year.
Now, we also know that for a lot of these oil companies, particularly those that refine fuel, they're going to see their margins squeezed a bit by higher oil prices. Can you explain if most of these big oil companies are seeing their margins expand or contract at this point?
Generally, we've had pretty good results for the refining business, and part of that's because of what we've seen, kind of a disconnect in price and different types of crude oil. Normally, West Texas Intermediate, which is the oil we normally hear quoted in the media, trades at a slight premium to Brent crude, which is out of the North Sea. But what's happened is in Cushing, Oklahoma, where WTI or West Texas Intermediate is stored, there's a lot of inventory, and there's not the ability to get that oil easily out, so that it's kind of created a disparity in oil prices. And those refiners that can take advantage of that lower priced crude are getting better margins.
Okay, we also heard from Caterpillar this morning saying that rising oil prices are a result of too much demand and not enough supply. You have gasoline here in the U.S. averaging about $3.89 a gallon. Do you see it going up to something in the neighborhood of, say, $5 by the summer?
I think that may be a little bit too high, and in the past we've kind of seen resistance as we approach that $4 level. Recently, there's been a little bit of a slack in demand, but we don't know if that's going to be sustained or not yet. But if it is, gas is going to have a much tougher time reaching that kind of level. Okay,
so $5 by summer might be too aggressive. These energy companies are obviously making a lot of money. They've got a huge amount of cash. How are they going to use that cash?
Well, one thing that they have been doing, especially the smaller companies that adjust their budgets more nimbly, I would expect that over the course of the year they'll increase their CapEx budgets, and they have been buying acreage and things like that. Chevron, in their earnings report that came out this morning, said that they bought 1.5 million acres in Romania, so that I expect them to put some of that money to work in terms of finding and developing and gaining access to new resource.
Okay, what about those that are still divesting assets like ConocoPhillips?
Those companies, there's a good market for that, and I think the companies that are doing that, Conoco is a good example, BP is another, they're getting rid of some of their higher cost assets in terms of what they can bring to them, in terms of the expenses associated with them, and basically improving their overall profitability. That's been a big part of what's driven the improvement in Conoco stock, is getting rid of these high-cost fields, getting really good prices because there's lots of money out there to be able to buy them from them, and then improving their overall position going forward.
And let's bring in natural gas to the mix here. What about the outlook for natural gas with crude oil at 113, 114, and regular unleaded gasoline moving higher because of this demand?
Natural gas, in the U.S., I still don't have a real optimistic near-term outlook for natural gas. Over the longer term, I think that it will be a good place to be. But we're still not there yet in terms of doing things to increase demand. I know there's been some talk in the energy policy, but there's nothing concrete yet.
Right.
So I still think it's time to wait.
Okay, so still wait and see on nat gas, but for now, crude oil, 31-month highs, around 113, 114 a barrel. Thank you so much. We've been speaking with Phil Weiss of Argus Capital Research.